Good afternoon, everyone, and welcome to our Summer Professional Advisory Workshop. I'm Kate England, President and CEO of the Community Foundation, and we welcome you and thank you for taking time to join our informational session today. We just really want to begin by, again, reaffirming and thanking you for the important role that you carry out in our communities across Northeast Iowa to connect your clients to the charitable good that they wish to contribute to here across our region. So over the past 8 years, it's been really a joy for me to meet with donors and their professional advisors as we share those options and opportunities they have to impact the communities that they love. And you really do provide that expertise and the tools for them to really maximize their gifts and create those tax-wise giving opportunities for them so they can do their life-changing impacts to the communities. So again, we're just so grateful that we have that opportunity to be part of that partnership, and we sincerely thank you for the important work that you do every day. So since our last professional advisory workshop, the Community Foundation of Northeast Iowa celebrated our 65th anniversary in May, and we exceeded a milestone of granting out over $101 million during our history, which is such a nice big number. And we've exceeded over $132 million of assets under management as well. So that charitable good just continues and continues. So again, we're just really blessed to partner with our communities and the generous donors who drive our work and support the wonderful nonprofits that really do enrich our communities every day. So thank you for that important role that you play in that beautiful relationship of charitable good throughout our region. So it's certainly rewarding and inspiring work, and we thank you for being a part of our organizational history, and we look forward to continuing to expand that role of philanthropy and community leadership as we inspire people and connect resources to enrich our communities as our mission drives us to do every day. So thanks for joining. Thank you especially to Todd, who happens to be on our board of directors here at the Community Foundation. And we're just really excited to learn together. So I'm going to turn it back over to Lori.
Thank you so much, Kate. Just to introduce myself, if we have not met, I am Lori Everhart, Director of Development here at the Community Foundation of Northeast Iowa. Happy to be getting to know all of you and start to see faces. So I wanted to welcome you to our third PA event of 2021 and to let you know that we're excited that we are making plans to be together in person back at the Community Foundation offices for our next PA seminar on Tuesday, October 26th. So we will go back to our previous format with lunch at 11:30 and our presentation at noon. So we're just so excited about that and getting to be back together in person. And just to let you know, we do continue to work on some technology options. We hope to have some type of virtual option for those who can't be with us in person. So as we get closer and finalize the program and start to send you information, we will certainly include information on that for those of you who that may be a more convenient option to be able to join us. So today's session will, as usual, have our continuing education credits available. And for those who want to take it down now, the CLE number for our 1 hour is 365298. And I will put that in the chat as well for those of you who need the CLE number. And I will also plan to include it in a follow-up email, and would be very helpful to me. When we're in person, we have a sign-in sheet. If you could take a moment and just do a little roll call by putting your name in the chat, especially if your name on your screen for some reason does not match who you are. If you're using someone's iPad or doing a phone or something like that, that's very helpful to me to be able to match names with the screen. If you need CFP credits, you can send me a message through the chat, a private message with your number so I can add you to our list, or just put a note with your name that you need the CFP credits, and I'll be sure to get in touch with you for your number to make sure that, that those credits are available to you. And lastly, just before I introduce Todd, I just wanted to ask you also to use the chat box for questions as you think of them. I'm going to monitor that, and as we have some natural breaks in the presentation, Todd's going to let me know to ask if we have any questions, and we will go ahead and take those at that time. So speaking of Todd, I'm going to go ahead and introduce him so we can get started. So Todd Henningsen is a wealth advisor at BerganKDV Wealth Management. He joined the firm 5 years ago through a merger with a local registered investment advisory firm, Heartwood Investments. Todd assists high net worth individuals. Oops, hang on a second. There we go. High net worth individuals, families, and businesses in meeting their wealth management goals. Todd graduated from the University of Northern Iowa in 2009 with degrees in finance and real estate. He also holds the CFA Charter and CFP professional designations. Before joining the team at BerganKDV, Todd served as an equity analyst and portfolio manager with Heartwood Investments. And Todd has been involved with the Community Foundation as a member of the investment committee, and currently serves as treasurer for the CFNEIA board of directors. And outside of work, Todd enjoys reading, traveling, and spending time with his wife, Nicole, and 2 children. So I will turn it over to Todd.
Thank you very much, Lori, for that introduction. I want to just check first, make sure everyone can see the slides and that's showing. If you can give me a thumbs up, Lori, if all that seems to be working. Thank you very much. So yeah, thank you all for making the time available today to be part of this professional advisory webinar. And really my goal today is to take you through, certainly the title here is Planning Challenges and Opportunities in 2021. And as I was going through this, I feel like I'm probably just scratching the surface. There really are a number of really meaty topics and areas right now as we work with our clients. So I'm going to just highlight some that seem to be recurring questions or very topical at this point in time. And as Lori said, if you would enter questions in the chat as we go, we can stop. And then at the end, open it up for questions as well. But even more than that, we've got a lot of assembled knowledge and expertise on this call today. If others would want to share other planning challenges and topics that they've been dealing with, that would be certainly welcomed as well. So hoping to leave some time for that at the end too. All right, so let's dive in here. So we're going to start off kind of in the investment side of the world first. And one of the challenges, and this isn't new, but it continues to be a challenge, is just simply the low interest rate environment that we find ourselves in. And so the graph that you're seeing here is a graph of the 10-year US Treasury bond, and it goes back to 1960 is when this graph starts. And if you can see on the left-hand side here, you can see over time and through the inflation of the 1970s, that 10-year Treasury rate steadily increased and then peaked in 1981, a bit above 15%, which honestly doesn't even seem like it could have potentially happened given the rate environment that we live in today, but it did in the past. And pretty much since that point in the 80s, given some of the innovation, given some of the Federal Reserve policies in place, inflation and interest rates have pretty steadily been on a decline since that period of time. Certainly there have been short periods of increases in rates as you see here, but the trend is certainly a downward move. And kind of really, accumulated in at the beginning of 2020, we were already still stuck in this low rate environment. And then as COVID started to make its way around the world and as economies started to shut down, and it became clear that this was going to be a very impactful event, not only from a health standpoint, but from an economic and market standpoint, the Federal Reserve stepped in very strongly to not only drop rates to zero for short-term rates, but also to come in and do a large amount of bond buying, not only government bonds, corporate bonds, and mortgage-backed securities, which ultimately pushed the 10-year treasury down to 0.52% at its low in 2020. And, kind of operating in the world that we are, it may not seem that odd, but if you take a step back and just think about it, kind of conceptually, if you're buying a 10-year treasury at 0.52%, you're locking yourself into earning 0.5% rate of interest for 10 years. So that's something that's hard for many of us certainly to wrap our heads around, and also likely many of our clients as well. So this remains a challenge. Now the rate has bumped up, and we're kind of around that 1.4 to 1.5% on the 10-year treasury, but certainly still a challenge. So what are some of the reasons why? So certainly, COVID and some of the response of the Federal Reserve was a piece of this to drive it to its ultimate low level, at least so far that we have seen, but some longer term trends that are in place as well. So, I mentioned before lower rates of inflation. And so that's a component that goes into interest rates. Another one is lower economic growth. In the 50s, 60s, and 70s, as women entered the workforce, we had a higher growth rate in the U.S. population. Economic growth was running at higher rates, and over the last decade has been one side or the other of 2% for GDP growth in most years. And not a hard rule, but just sort of a general guidepost that I use for, what would be a potential fair value, if you will, for the 10-year treasury, taking the US GDP growth rate plus the inflation rate is sort of at least a starting point. And, certainly doesn't always match there, but as an example, if the growth rate is 2% and the inflation rate is 2%, 4% could be at least a starting point there. And so, with lower inflation, lower economic growth, those have been big drivers. Another one, certainly, Federal Reserve intervention, particularly starting after the financial crisis and really lasting the past 12 years, and COVID really kind of coming back in full steam as well. So not only, adjusting interest rates, but also using quantitative easing. So purchases of government securities to push down longer term rates and not only short term rates is a pretty new phenomenon in the US. And that's also helped push rates down as well. And on the demand side of the equation, aging populations in the US and globally have caused a very high amount of demand for safe, longer-term securities. So not only individuals, but institutions and pension funds that ultimately serve individuals have had a high amount of demand. And so, while these low rates in the US are certainly a change, also within the global context, many European bonds in Japan are actually trading at negative interest rates. So the US still looks fairly appealing and has gotten a large amount of demand from international buyers as well. So certainly this is a challenge for clients who may be in a retirement phase and had hoped to shift down the risk level from stocks to safer bonds over time. So this is something that we deal with really on a day-to-day basis as we work with clients. In my mind, there are a million different potential ways to deal with this, but they really kind of categorize into 4 different approaches. So thinking about this not only from an investment standpoint, but also as we build financial plans for clients throughout their retirement years. So, one approach is to continue, with your allocation that you've set right now and to not make any changes to your planning assumptions, sort of the burying your head in the sand approach. And I would say that certainly is an approach, and one that frankly probably many people take. But I would say not the best way to move forward. So one of the things that we've done as we build in our financial plans is, we have given a haircut to our returns assumptions. So many times financial planning software is built off of historical rates of return. So maybe 10 to 12% rates for stocks and 4, 5, 6% rates for bonds. We believe in the current environment today, those numbers need to be adjusted, not only for today's reality, but for what may be a low rate environment well into the future as well. And if you're making those changes in a financial plan, that may also mean that you need to change your spending path as well. So things to consider as you talk with clients. Another one would be, to simply increase your level of risk. So maybe you're kind of, buying into the approach of lower returns for bonds and even for stocks, but you want to keep your expected return of a portfolio intact. Another way to do that is simply to use more stocks as part of the equation. So if you're maybe a 60-40 portfolio, moving up to a 70-30 or an 80-20. Now, of course, that isn't a free lunch. That longer term expected rate of return, has a good probability of making its way into portfolios. But over the short term, the more risk you bring in, the more volatility you're going to see. So something we often ask clients to consider is, are you able to take that risk, given the assets that you have and the spending and the job that the portfolio needs to do? And also, are you willing to see that happen? And last spring was certainly a good way, sort of a test by fire for a lot of clients who hadn't seen a level of volatility that high in almost 10 years, or even more than 10 years. So really, being true with yourself, are you going to let that portfolio then, work its way through a bad market without making any big changes? So that's another way. And then the fourth one here is the potential to use alternative assets. And when I say alternative assets, a number of different things could be thrown into this category, but things like private equity, private real estate, certainly as many of us follow what's going on in cryptocurrencies, others might put commodities and gold in that basket as well. From an institutional standpoint, you know, many larger institutions have used alternative assets as a way to combat this issue. As an example, as Kay said, I sit on the investment committee for the Community Foundation. The Community Foundation has used private equity and private real estate and continues to do so. Given, you know, the way that the Community Foundation is set up, where really the investment portfolio is meant, you know, for not only now, but into perpetuity as well. So a number of institutions have implemented this approach. And I would say the success of that has varied pretty dramatically. So, you know, there's not a ton of dispersion in stock and bond portfolios for the most part, but in alternative asset portfolios, there has been, if you look at the success. So especially as we think about this for individual investors, certainly this is an avenue that you could pursue to diversify and also potentially increase your return. But I would urge people who are considering this avenue to tread with a great degree of caution and skepticism if they're going to move forward in this way, and to truly understand what they're getting into if they're going to move in this direction. So those are some of the options that I see for combating this. There's no silver bullet. There's no easy, you know, just buy this or that to combat this. But those are really, in my mind, the options that are on the table. The next challenge that I see is inflation. And so this is a graph of the Consumer Price Index, which is one of the most widely tracked US measures of inflation. And this is actually the number through April. So you can kind of see this spike up to just a bit above 4%. And actually the May headline number was above 5% for inflation. So, you know, really something we have not seen in quite some time. And actually you have to go back to August of 2008 to see a headline inflation number above 5%. And if some of you remember that time frame, we were dealing with mostly high commodity prices at that point in time. Crude oil topped $130 a barrel at that point. And so, now the debate that is out there is the inflation that we're seeing now today transitory, which is the word that the Federal Reserve has used, or temporary, if you will, or will this be more permanent in nature? And I'm not going to try to make that call here today, but to lay out kind of both sides of that case, the case for this being transitory really has to do with, the unprecedented nature of COVID-19 and the response last spring to really put the economy in the US and globally on ice for at least a month, and then a very gradual thaw of that, of the economy over that period of time. And so the thought process there would be, as some of the supply comes back online, as we're sort of getting past some of the really low price numbers that we saw in early days, around COVID, that inflation will go back down to more reasonable rates over time. And, an example of this would be many of you have read about some of the supply constraints in the semiconductor chip industry and their effect that they've had on the automotive industry. I saw a good aerial picture of the Kentucky Motor Speedway over the last week, and all of the Ford F-150s that are parked right there now that are completed and are ready to go to the dealerships, but just need the chips to arrive. And many of you, whether it be lumber prices, food prices, if you're building a house right now, certainly you're feeling that impact. So a lot of us see that, some of the supply constraints and some of the price increases. And the hope would be, and the Federal Reserve's guidance is that this will be temporary. Now, on the other side of that argument, that this could be more permanent in nature, is the amount of money that has made its way into the economy since the start of COVID. So not only the Federal Reserve doing a large amount of bond buying, which is pushing money into the economy, and also the stimulus checks that we saw, come into the economy throughout 2020 and 2021. But now the administration also proposing a large infrastructure bill, which would be stimulative, and also some social programs that could be as well. So, reasons for both sides of this equation to potentially be right. Some of you might be thinking, okay, that might matter for my pocketbook and my spending, but why does it matter for the markets? Well, inflation, at least persistently high inflation, is very damaging for investors. And an example of that is during the 1970s, when we go back to the very high rates of inflation, very high interest rates, the inflation adjusted or real rates of return earned in the US stock market during that time period were actually lower than the rates of return during the 1930s, which was during the Great Depression and the start of World War II. And, without inflation is the worst decade in the stock market in the US. So just showing how that inflation adjustment makes a big difference and can be damaging. Now, looking at some longer term expectations of inflation, and this may be a little bit hard to read, but the right-hand side here has really three different metrics. So, the orange bar is one that I kind of like to follow and use. So this would be essentially the difference between the 10-year Treasury inflation protected security yield and the 10-year Treasury. And so that's just that, looking at the 10-year Treasury bond today and the inflation adjusted and taking that difference in yield. And the expectation there built into that is that inflation would be about 2.5% on a longer term 10-year move forward basis. And so, while the inflation expectations have certainly moved up for longer term, they're still not at ultra high levels. And this is actual dollars working their way into the markets and really placing sort of I don't want to say a bet, but an investment behind these outcomes, if you will. So these are good metrics to follow and look at as you're thinking about this longer term in nature. Before I move forward, Lori, any questions that have come in?
Not yet. Thanks, Todd.
Very good. Now looking at some different periods of inflation over time and how different securities and different asset classes have performed. Now, this is a study done by JP Morgan, and it actually goes back to 1988. So it doesn't include the really high periods of inflation during the 70s, but a more subdued inflation environment. And you can kind of see at the top here, so during periods of rising inflation or falling inflation, and then if you have above average inflation or below average, using 2.5% here. And so kind of just looking at, in general, the green bars are equities or stocks, the blue bars are bonds and cash, and the gray bars are more alternative types of assets. One of the things that stuck out to me when I saw this chart is during times of either high or rising inflation, equities tend to be some of the best performers in those environments. And particularly if you look at the category of EM equity, so that's emerging markets equity. And so that was one where, if you really think that inflation is high and is going to continue rising or is going to stay high, and you don't have any exposure to emerging markets in a portfolio, could potentially be one to consider, but a number of other things here as well. So that's kind of a bit about the investment side of the world, and I'm going to transition kind of now more to, more, I would say, financial planning, tax, and estate planning topic areas. But yeah, certainly in the investment side of the world, ultra low bond rates, high valuation levels for stocks currently. But, the reopening of the economy after COVID, certainly a tailwind behind markets. So a lot of different things to consider when you're building portfolios right now. The next piece that I'm going to touch on here from a planning standpoint is the loss of the stretch IRA option. And this is not new. So this was passed as part of the Secure Act in December of 2019. I do feel like with the last year of COVID and everything that happened, it was one of those things that got talked about a little bit right after it happened, but hasn't been sort of on the front burner for people's minds, but is actually a pretty important thing for, in my view, probably a lot of our clients in the community, sort of the millionaire next doors who may have large dollars in pre-tax retirement accounts. So what this does, so before this was enacted in law, for using as an example, your children most often are who people choose to be the beneficiaries of their retirement accounts. Now, there are lots of different options, but that's one that tends to be a common one is children. If the IRA owner passes away, the child could set up an inherited IRA and then use their lifetime to take distributions from the IRA, or what was considered the stretch IRA. Well, now the stretch option is really only available for what are called eligible designated beneficiaries. So that would be spouses, those 10 years or less younger than the IRA owner, disabled individuals, and minor children. For most others, there is now a 10-year rule in place. So the dollars have to be taken out of an inherited IRA within 10 years. And so this is certainly a change for a number of people and is likely going to have an impact on a number of our clients. A quick note here is this also applies to Roth IRAs, the same rules. So certainly a distribution from an inherited Roth IRA doesn't create a taxable event as it would from a pre-tax account, but it eliminates that ability for you to be able to grow that inherited Roth IRA over your lifetime as you're taking smaller distributions. So a fairly meaningful change. So what are some of the strategies and options that you can think about here? Well, for current owners of IRAs, one of the things that I think is a pretty common planning technique for people who are retiring in their early or mid 60s, and they may see a drop of their income and also lower tax brackets, the consideration of Roth conversions or larger distributions from their IRAs before they start Social Security, before required minimum distribution age, already a planning concept, but now maybe even more important for those clients. So something to seriously consider in that arena. And also as well, there are a number of other strategies too. So one would be thinking about sort of multi-generational tax planning. So not only tax planning for the current owners of the IRAs, but also thinking about the beneficiaries. As an example, maybe a woman has, let's say she's 65 and she's going to give her IRA or her assets to her two children. Her son is a school teacher and her daughter is a surgeon. Well, general planning may say, well, if you want things to be equal, you give 50% of all of your different assets to the two children. Given this change, and maybe even before this change, but especially given this change, you may want to consider optimizing from an after-tax standpoint, which would mean, maybe giving a larger chunk of your pre-tax dollars to your son who's a teacher and more of the after-tax or taxable dollars to your daughter who's a surgeon, to sort of optimize, not the pre-tax amounts, but the after-tax amounts and using the kid's situation. So certainly more complex to do that, but something that should be considered to be efficient from a tax standpoint. Another option would be to utilize charity. So this has certainly always been an option and a way to give efficiently at your passing to charity. But, and you're going to see this kind of with a number of the tax proposals and the state proposals. To me, somewhat ironically, since we're, Community Foundation is sponsoring this, charities could be one of the biggest beneficiaries of potential changes that we see over the next few years. As it's, for those that are charitably inclined, going to be even more advantageous to give there. So one option would certainly be an outright gift, so making a charity a beneficiary, or also utilizing a charitable remainder trust as the beneficiary. So what that would allow you to do is upon passing, your assets would pass into a charitable remainder trust, and the income beneficiaries, again, assuming that this would be children, could then get payments from the charitable remainder trust over their lifespan is one option, or for a period not to exceed 20 years. So you could essentially bring back the stretch for your children in a way by utilizing a charitable remainder trust. Now, the downsides to this are one, there wouldn't be any flexibility. So if one of the kids needed it for a down payment for a house, to pay college expenses, they're going to be limited to the income payment that's going to come out of the charitable trust every year. Another drawback is, obviously, once the income beneficiaries pass away, then it goes to charity, so would be no longer available for next generations. And then lastly, certainly there is a level of complication in setting up a charitable remainder trust. So there's going to be a cost of, legally drafting the document. And then once the trust is funded, there's going to need to be a separate tax return for the trust. So this is something, if you think about it from a scale perspective, probably not something for someone to consider for a $100,000 IRA, but maybe $1 million plus IRA. We've had conversations like this with some of our clients who are charitably inclined. At this point, none of them have decided to move forward with this approach, but I think it's something that that should be strongly considered for those that have, both a want to stretch payments over an income beneficiary's life and also have longer term charitable intent as well. All right. I'm going to pause just one more time here before kind of the home stretch. Lori, any questions that have popped in?
I think everyone is just wrapped, with what you're saying, Todd. They haven't even had a chance to think of questions, so you're doing great.
Either that or very busy with lunch or taking a nap or something, right? So, all right. So kind of shifting now into, some of the current tax and estate proposals. And before I jump in here, I'll just sort of caveat this with there's a lot of information that's been put out there at this point. There's a lot of moving pieces. So I don't consider myself to be the world's expert in this area, but my goal would be just to sort of lay out, what some of the main proposals are, and some ways to think about them for clients moving forward, and mostly focusing on individuals versus the corporate side of the equation here. So one of the tax proposals from the Biden administration would be increasing taxes, and the reason to do that would be to fund what they call the American Families Plan, or what they've deemed as a social infrastructure plan. Different from the actual physical infrastructure plan that's in place as well. This would be the social infrastructure plan. And so some of the things that this would fund would be essentially adding 2 years to common public education. So 2 free years of preschool and 2 free years of community college for most individuals. That would be one avenue. Also, direct support to limit childcare expenses for low income families, low and medium income families, something certainly a lot of us read about. If in a lower medium income family, more often than not, if you have a handful of children that need childcare, you may be in an equation where it's actually going to cost the family money for one of the 2 spouses or for both spouses to go to work, and so that's what they're getting at there. Also would expand the credits for the child earned income and dependent care tax credits as well. So that would be some of the things it's meant to fund. Now how will they go about this? So the first piece would be increasing the highest marginal tax bracket to 39.6%. This is probably, frankly, the least controversial and least revolutionary part of the proposal. This was something, we were in this realm during the Obama administration, would be just simply moving back in that way. It would also, and this is where things get a bit more revolutionary, it would increase the rate on long-term capital gains for those with adjusted gross incomes above $1 million. And a lot of clients are confused. They say, is this $1 million in net worth? No, this is $1 million in annual adjusted gross income. But if you fall into that bracket, then the rate moves from the current advantaged rates and meets up with the current earned income rate. So for those with a AGI above $1 million would be 39.6% plus the 3.8% net investment surcharge as well. So an all-in tax rate of 43.4%. So that is certainly something that has caught the attention of the planning world and would certainly be a big change if it were implemented. It's estimated that this would affect roughly 0.3% of US households. So it is really a very targeted increase in tax for those at the very top of the income structure. Another change would be to limit the amount of dollars that would be eligible for 1031 exchanges. So the exemption would be $500,000 per person or $1 million for a married couple on an annual basis. So if you're doing larger real estate exchanges as an example, those would be considered a taxable event at that time and not able to carry that basis forward. Another and potentially the most revolutionary or potentially complex piece of this would be the loss of step up in basis at death. And so the proposal here would be to have a $1 million per person exemption for capital gains at death. And also the same for gift taxes, so $1 million. So during life or at death, if you realize capital gains above $1 million as an individual, you will create a taxable event and there will not be an automatic step up in basis. Now, that tax that is paid on the gains would then be a deduction on the estate tax return. So it's not like those are piled on top of each other, but would certainly be a change from where we sit today. One of the things as I researched this, this was actually previously enacted in 1976. There was actually a previous law, the 1976 Tax Reform Act, that eliminated the automatic step up in basis at death. Now, as it was worked through administratively, it was pushed back, the implementation initially, because it was too cumbersome. Think not only small businesses, farms, but at that point in time, cost basis tracking for stocks and bonds wasn't near what it is today either. So a lot of complexity, and ultimately it was repealed before it was actually ever implemented. So this has been tried before and was found too administratively complex. So why approach it in this way? And I think one of the main reasons is, looking at the share of, using the market value of the US stock market as a gauge for the concentration of wealth in the US. So a study by the Federal Reserve Board shows that the top 1% of US households hold 38% of the wealth. So almost 4/10 of the stock market value in the US. And that's 1% and 40%. And the top 10% are estimated to own about 85% of the stock market value. So really looking at that, at that concentration of wealth and try to find a way to potentially to tax that. And as many have likely read some of the ProPublica reports on some billionaires' tax payments, just further fuels that fire potentially as well. One of the interesting pieces here as well is the potential for, not for the loss of step up in basis, but for the higher capital gains rate to actually be implemented retroactively. So in the Treasury's Green Book, which describes the Biden proposals, the enactment date would actually be April 28th of 2021. So that's when it has been laid out. Now, generally, kind of speaking with some of my tax colleagues and thinking about past law, if they're going to implement something retroactively, it would generally be to the date of the actual enactment of the law, not to the announcement date. So this change is legally possible to be made, but it's not likely to be retroactive, but something to certainly consider for those that are planning. And this has been proposed by the Biden administration, and there is actually a current act in Congress called the STEP Act that is aligned with many of these proposals and working its way through Congress right now. So, what are some of the, the opportunities here? And I put, the top line here, this is actually great for advisors, if not for all of our clients. Certainly a reason to engage with our clients and to talk with them, to evaluate the opportunities that are available. well. Kind of thinking about the conversations that I've had, talking with some of my colleagues, one of the things that we've noted, we're seeing a lot of inquiries from clients, and even those with modest net worths and annual incomes below that $400,000 limit that was put out there by the Biden administration for sort of a red line for not increasing taxes. Many clients considering selling real estate properties now where they would have done 1035 exchanges just to get rid of that uncertainty. So some consideration there. Similarly, for business owners who are considering a sale within 3 to 5 years, stronger consideration of moving forward in 2021. So that's kind of the conversations that we're seeing right now. And then kind of, potential thoughts for different categories as you're talking with clients. So the first category would be those with under $400,000 a year in income and somewhat modest net worths. At least as the proposal is laid out, there is not likely to be major changes and impacts from this. So certainly, a reason to reach out to those clients and say, not likely to affect you, at least as it's out here today. For those with ongoing incomes above $1 million, then, considerations for things like, asset location for portfolios. So some of, before realizing more capital gains and more growth assets and taxable accounts, and some of the more safe assets and income generating assets in IRAs, some of that potentially gets flipped on its head if this is enacted, since you have pretty much a level playing field then, and you don't have an advantaged tax rate anymore for capital gains and dividends. So a consideration for portfolio construction. Also, considering highly appreciated assets that could be sold within 5 to 7 years, and then clients that may be within 5 to 7 years of death, looking at gifting now versus, waiting for that step up in basis. So conversations that, as some of these proposals work their way through Congress, should likely consider. Another quick note, it's also an interesting situation for a lot of professional services owners of firms. So owners of law practices, CPA firms, wealth advisory practices, in general, most of those firms on average are owned by those in their 60s. Many of those people have said that they're considering a sale within 5 to 7 years. And more often than not, the basis in the business is very low. So kind of interesting in nature, many people are going to be helping their clients with this, but maybe also considering how this impacts their future and their business as well. Current estate tax proposals. So as we're getting a little bit short on time here, I'm going to run through these somewhat quickly. But in general, the Green Book and the Biden administration has not currently proposed a change to estate tax rates or the estate tax exemption amount. But there is an act working its way through the Senate, the 99.5% Act, co-sponsored by Bernie Sanders, that would make some changes to estate taxes. So it would lower the estate tax exemption amount to $3.5 million per person, would lower the gift exemption to $1 million per person. Its effective date would be 1/1/22, and would also limit some of the planning opportunities for grats, as an example, would eliminate the ability to do a zeroed out grat or rolling grats with some of the new provisions, and also could present challenges for irrevocable life insurance trusts. At least as it is written right now, assets transferred into a grantor trust would be included in the grantor's estate under a new proposal. So that's going to be something to watch and potentially tricky. Even if nothing changes, no new laws are enacted on the estate side, remember that in 2026, the exemption amount reverts back to $5.5 million per person adjusted for inflation. So even if nothing happens, still some opportunity for for planning and conversations with clients. So certainly, as you think about estate taxes, the consideration of 2021 giving. So if you have not used your full exemption amount, that is a potential consideration. Annual gifts during lifetime to lower estates. And again, the ability to use charitable giving as a piece of your ultimate estate plan, or while you're living to lower your estate amount, becomes, for those that are charitably inclined, potentially even more important. I've got a couple more slides here, but I want to leave time open for discussion and conversation. Thank you very much for the time today. I would welcome any questions or conversations at this point.
Thanks, Todd. We did have a question from Mike. Mike, why don't you go ahead, if you want to go ahead and come off mute and just ask that question.
Thank you, Todd. Appreciate all the insights. It was just around the potential elimination of the step up in cost basis. A couple of things. It's more of you looking into the crystal ball with your own opinion here, but even with the improved tracking of stocks and bonds and things like that over recent decades, there's still a lot of assets out there that were bought a long time ago, especially real estate, that the heirs won't know the basis. So that's the first part of it, is that's likely to create a mess for a lot of people that would be impacted. And any comments on that? And then secondly, given that, what are your thoughts about the odds of Congress actually supporting something like that?
Yeah, great question. So, kind of using one sort of expert in this area. So Ed Slott, which may be a common name to some here, sort of in retirement and tax guidance, he has given a 0% probability to the elimination of a step up in in gains. To me, I agree completely, Mike. I think this would be incredibly messy, particularly for small businesses. Farms is another example. There have been some provisions that have already been talked about to make that, make that less onerous for people. It does seem like, though, a key part of the Biden administration's overall philosophy of eliminating the, potential benefits of, ownership of assets versus earned income. So that would be the only thing that sort of aligns with potentially, something moving forward there. I would say the probability, I don't know, I'm literally guessing, but less than 50% would be my guess. But I think it's higher than 0 as well. And if not now, they're laying the stage for it as well, and potentially in future administration. So something to start to consider, even if it's not enacted now.
Thank you.
Great. Did anyone else have any follow-up questions? Feel free to come on off mute and all right. Well, hearing none, I'm going to take a moment to thank Todd very much for his expertise and sharing of his knowledge and taking the time to do that with us. We certainly appreciate having so many great people like Todd to be able to call on to help with our continuing education here at the Community Foundation for our professional advisors. And just to echo Kay's sentiments, again, thank you all for the work that you do to assist us in our mission. We are so fortunate to be able to work with you and to work with your clients in their charitable goals, and just appreciate those opportunities. So I think we are going to call it a day today, and just thank you very much for your time and for being here. And there will be a follow-up email that will have some additional information. Again, we'll give that CLE number again. But if you have any questions, feel free to reach out to myself or anyone here at the foundation, and we will be sure to answer any questions for you. So on that note, thank you again to Todd, and everyone have a wonderful day.